Now in this segment, we want to jump off with where are jobs. And here you can see that the payroll for April added 428,000 jobs, continuing to be strong, continuing to see the employment level. And if you go back to the forecast in January of 2020, we're coming very close to where we were pre-COVID. And that's a positive, but at the same time, you still have participation rate off. You still had what was called, I think it was the Great Retirement or the Great Resignation, and now you're starting people that were in retirement starting to come back. But because those people aren't looking for jobs, because they're not in the market, you have an unemployment rate at about 3.6%. And keeping it that low, again, increases competition for jobs, increases wages, which is normally a positive. But then you start getting that fear of a wage spiral, which is something we've talked about before and we'll discuss as we continue to go forward. So then when you look at U.S. average hourly earnings, we actually missed estimates. So this is a problem because wages have gone up, but they're going up less than expected, and they're going up less than inflation, which is why we continue to see the pressure on consumption. And the biggest surprise was the slower wage gains. And the problem is, are companies hitting the limits of their pricing power? And you're starting to see that, as we talked about in the last segment. Companies are starting to slow down the price increases. And if you can't increase prices, well, can I increase wages? How can I increase wages if I can't recover some of that cost and maintain some semblance of margin? On the positive side, the addition in payrolls was pretty much across the board. There wasn't a huge driver to it, which is just showing some of that health, which is a positive in general. But then the issue is, at what rate are they coming on, which is, I think, a bigger piece, because when we look at the bump, so when we look at the bump in which people are coming back to the office with, about 23% said that they got a pay increase of 5% or less, and about 30% said 6 to 10%. So if we know where we are, so let's just say about 55% are 10% or less, you just barely covered inflation. So you really needed to be north of 11, 15% to get above where inflation is. And you can see that's why, based on the shift to this, even if you got a new job, maybe you just covered inflation or slightly below, which again creates some of these other additional problems, such as when you look at U.S. personal savings continues to fall, and are we starting to get into the debt to keep up our spending? And this is, I think, a good shift between savings coming down, or savings rate coming down, which means people are spending more, and debt going back up. And you can see, as we've been saying, we're right back to where we were during pre-COVID period. And this is when you look at the market is currently pricing in those 10 rate hikes. So you have rate hikes going up. So companies are their cost of borrowing is going to go up. So if their interest expense goes up, and their rent is going up, and their cost of goods is going up, and then their wages are going up, well, how are they going to continue to hire? How can they continue to get the strength that they normally have, which again speaks to the underlying problems we're seeing, which is where, when you start looking at ISM, the report on new orders coming back down. When you look at price index, still elevated, coming down a bit, but again, as we've been saying, enough to keep us up there. But new orders are now coming closer and closer to contraction. And depending on the numbers that we use, are already in contraction, which just, again, is that leading indicator for where things are going and the problems we expect. ISM Manufacturing PMI was expected at 57.6, came in at 55.4, and the contribution, again, the supplier side was a big driver to it. But if you think about the supplier issues, that's really a net negative, but yet it's a positive, and that's what we keep talking about. Now, new orders are slowing, but supplier deliveries are going to get much worse, or delivery times are going to get much worse again in May, June, and July, and then probably beyond, depending on how quick China can kind of adjust itself, and that's creating some of these artificial pressures to the upside, where it looks good, but realistically, it's still going to be an inflationary driver and a problem for the market. which is when we start looking at those new orders. Survey was for 54.1, came in at 53.5, but employment had a big drop. So the survey was for 55, and we just eked out growth at 50.9. So again, we had some of that growth. It's just the pace of hiring is slowing considerably. And based on where we're going, we think that that's going to go negative, not by a huge number. Like, it's not like we're going to go into the 40s or whatnot, but just, I should say low 40s, because I think we can get that 48, 49 where people are, starting to balance out, not really hiring, maybe, letting one or two people go. And you're starting to see kind of that reaching that pace. And it's due to a lot of the factors we've highlighted back in segment 2. So then the customer inventory continues to rise, still very low, but starting to rise, which is just, if you're a customer, you're going to go in and say, that's expensive. I have 2 at home. I'll come back in a week and see if prices have come down. And as your inventories build, you have that flexibility to essentially reject pricing and delay some of that consumption. Prices paid was expected at 87.4, came in at 84.6. Just kind of sitting there. And now we expect to have a prices paid going back up as the supply chain issues catch up with it. Because remember, it didn't really hit in May. It hit the first, the back half of April, and then it's going to hit in the back half of May, and things are going to continue to worsen. Which is then when you look at services, PMI expectation was for 58.5, actual came in at 57.1 as the consumer continues to ratchet back a bit, slowing things down. And that's what we're seeing with new orders as we look forward. You're coming to a point of concern, and that's where we see more of that slowdown. And that's when you start looking at services, PMI, supplier deliveries continue to be a driver. Business activity, which is a positive, was a driver, but again, the supplier deliveries. Employment, on the other hand, fell to 49.5. And that's where we will get a little bit of a bump as we get into May, just for seasonality. Because if you think services, you have vacation spots, you have things opening back up for the weather. So you'll get a little bit of a pivot back up. But again, you're already seeing how we're bumping along the bottom. And this is what I think the manufacturing side is going to look like. And you're going to see a little bit of that slowdown. Now, supplier deliveries for services are moving back up. We expect that to move higher. And then prices charged, as we showed in CPI, move back to the highs. And that's where we see prices charged moving to the highs, manufacturing coming down a bit. Now we expect this to almost flip, where prices charged for services come down a touch, and then manufacturing moves back up, especially as delivery times continue to worsen. The U.S. trade balance, to give you an idea of just how bad it was in March, is it was expected at negative 107, came in at negative 109, and real good exports were fairly flat, while real goods imports surged. Now, this is just looking at pricing and again, importing inflation, which is continuing to be a theme that we've discussed and talked about. And this will flatline a bit, but it just gives you an idea that even flatlining, you're still at highs. You're still going to be importing as much. Maybe you're not setting records. It's just you're still going to have a little bit of that drag, and that's going to be passed on to the consumer, to other businesses, which again is going to be some of those underlying problems. Now, the gap between job openings and unemployed continues to tighten, where U.S. job openings rose to 11.5 million in March from 11.34. The difference between number of jobs openings and unemployed now exceeds 5.5 million. Again, keeping that pressure on pricing, because if you're someone looking for work, you're like, well, that person's paying more, and I can get both jobs, so I'm going to go to the one that pays more, which is keeping that pressure on wages. But companies are now starting to see the hesitancy or the inability to pass that through. So this is when you're going to continue to kind of get them looking across the table. The employee wants X, the employer wants Y, and at what point do we see some of that cross? Or do the companies say, look, we need to raise prices, we need to raise wages. If you raise wages, they'll be able to cover the higher prices. And then that's when, again, you start getting into that wage spiral conundrum. So then when we look at more companies are reporting inventory increases, it also means that as they report inventories, they won't have to purchase as much, they can slow down, but this will also be a net positive for Q2 GDP, which again, as we've talked about some of the lumpiness, this is something that is worth looking at when you start talking about some of those different shifts. Now, CPI consumer, you can see that the huge shift to 8.5% and disposable income. So a savings rate has collapsed. And it's not surprising that as the savings rate has collapsed, CPI has surged, again, because you're doing one to get to the other, creating some of those feedback loops. Now, over the past couple of decades, tightening of financial conditions has tended to eventually coincide with a downward move in inflation. The question remains as to how much or how fast conditions need to tighten to put pressure on multi-decade high CPI. And if you look at the financial conditions, they're still supportive. They just went above, they're just getting to about a little bit more than tightening, but you still have the consumer at this in ungodly level. Now, we do think that you get that acceleration, especially as the Fed starts to actually enact those different things that we've talked about, starting in June. And they've been able to front run that by just giving their guidance. But again, you're seeing a lot of these pressure points. And as that gets worse, it's going to increase interest expense and underlying cost for different individuals. All the while, cost is going up for the consumer, and government transfers continue to fall. Normalization of income growth continues as government transfer payments now only account for 18% of personal income. Still above pre-COVID, but as things continue to expire, different programs, that'll continue to trend down at the worst time, because that's at the same time all prices are going back up. But at the same time, this could also push more people back into the workforce and enable some of that adjustment in terms of wage pressure. So U.S. consumers are still spending, but they're doing so with more discretion. And I think that's the biggest piece, is how is spending changed? They're cutting back on goods and indulging on services. But when you look at services are also starting to see a little bit of that softness as we saw in the PMI. Nominal outlays up 1.1%, but mostly reflecting 0.9% rise in prices, as real spending was only 0.2%. And we see that going negative. And that's the problem that we're looking at when we start discussing about GDP growth, especially when you start looking at the different pieces. That durable goods was down 0.9, non-durable goods down 0.3. Services up 0.6, but we see that, again, services will still be positive, just not quote unquote as positive, which is going to be some of that drawdown that we've discussed. While consumer spending appears to have been front loaded in Q1, a closer examination reveals that spending on services, the key engine of growth going forward, remains strong. Thus, again, which is why we've been talking about that rebuild or that strength in Q2, which we think does fall off in Q3. But things will be on a benefit side from the services sector. Then when you look at real disposable income is now slowing considerably. So the question will be, does disposable income catch up faster drawing down services, or does services carry us through Q2 and then catch up? Because eventually they'll catch up. The question is going to be, what quarter does that hit? My assumption is that's a Q3 event, not a Q2 event. But again, these are things that we're going to keep looking at and trying to assess and provide some of that guidance. So real disposable income is slowing considerably. Disposable income grows 0.5% in nominal terms, but fell 0.4% adjusted for inflation in March. While disposable income remains 1.6% above pre-COVID, it's now 3.7% below its pre-COVID trend and dropping, which again, is why we remain a bit concerned. Now, imports are overshooting relative to spending, which again is showing up in inventories, which is going to be a positive for that inflation, for that GDP growth number, which we've been talking about, and will be a net positive in general, which is why we think Q2, we do get some of that growth in general. So then, but the employment costs continued to go up. So we had a little bit of a pause, as you could see from the previous month, as we were talking about, but now you have that surge again. So based on some of the commentary, you're starting to see that roll over a bit. So the survey was for 1.1%, came in at 1.4%. Employment cost index year over year is at 4.5%. So month over, quarter over quarter, that resurgence. And now we'll see some of this, not so much come down, but really kind of flatline. And that's where we see a lot of this pressure into that stagflation piece. Now, employment costs benefits continuing to move up. U.S. personal consumption survey was for negative 0.1, came in at positive 0.2. Small, again, eking that out a bit, but we see that starting to change course. Now, personal consumption expenditures, when you look at it unchained or not inflation adjusted, continue to go up. But then when you adjust for inflation, you're seeing that we're just holding that line and starting to roll, just starting to roll over. And we see that acceleration in April. I should say April into May, and then it really hits, I think, with a vengeance as we get into Q3. All the while, new construction and large remodel contractors are still seeing 72% are showing some sort of delay, and that's from goods, that's from products not being available, labor not being available. So this is going to continue to be a problem as we go through the remainder of the year, especially when you start looking at mortgage rate payments, and when you look at interest rates and inflation-adjusted loans, you get an idea that loan size at 6% rates, you're seeing just the underlying shift and the total cost that is, and this is going back to 2000, you get an idea of just how expensive things have gotten and how quickly. And this is without the Fed actually selling anything on their balance sheet, which is why we think that things get much worse. Manufacturing prices paid and CPI inflation. When you get of where things are, again, there's some of that pressure that's going to keep things elevated. Not so much a resurgence, but just keeping things at this elevated level, giving more credence to the stagflation movement. Construction spending eased in April and grew 0.1% versus 0.8% estimate. So you're still seeing some of that, but it's all really on residential. And that's going to continue based on the delays, because you're going to continue to see those delays be an underlying problem. So then when you look at ISM Manufacturing fell to 55.4. But when you look at these different pieces, the key components are employment and new orders, and they're all moving in that negative direction, still expanding, but there's that pressure that we keep talking about. Now, real GDP growth, when you look going forward, the real GDP growth, excluding inventories, when you look at the different pieces, excluding trade and inventories, things were pretty good. And now as we get inventories a bit more positive, imports a bit more positive, that's where we see that growth in Q2, and really the bigger slowdown coming in Q3. So then when we start looking at home prices and composite construction, this is where we see a lot of that leading indicator and the pressure coming down, where U.S. construction activity going to over the next 6 months, as some of these things catch up, that's where we'll see some of these prices soften a touch, as U.S. personal consumption expenditure core price is at 5.2%. And when you look at the expenditure chain at 6.6%, keeping that pressure in the market as personal income continues to shrink and continue to come under those headwinds, again, in putting more pressure on people to actually spend, which is why when you look at the employment cost, well, if we want people to spend, if we want people to do these things, you're going to have to pay them more, creating what we're looking at when we're talking about that wage spiral. As the real final sales contracted, when we start looking at real final sales of GDP. So there's a lot of different ways to look at it. And it's the first drop in Q1. Now we think we get a bit of a recovery in Q2, but then the trend continues in Q3 and beyond, which is why we were expecting more of a recession in Q1 of next year. But we think that a lot of that has been pulled forward based on these underlying pieces. And then at the net exports at negative 3.2%, contribution to Q1 real GDP was among worst on record. And now that will adjust and then get much worse again based on when those imports from China actually show up. And that's when we start looking at manufacturing from Kansas City Fed, as you can see here, moving down. And from that estimate, new orders pulled back. Again, the leading indicators are showing a lot of that slowdown as you start looking at new orders coming closer to zero, prices received moving to the highs, prices paid moving back to the highs. Again, keeping that inflationary pressure in there, not so much breaking to new highs. The rate of change will slow, but not the actual deflation that I think some people have talked about, with retail inventories climbing 2% in March, up from 1.4% estimate. In level terms, inventories are firmly above pre-pandemic levels. And again, this is going to slow down some of that underlying spending. Chicago PMI survey was for 62, came in at 56.4. You can see that on the Philly side, the Philly also had a drop, and that's where you can see that pressure, again, pulling down that manufacturing PMI that we've spoken about. And then when you look at the new orders, we are firmly negative, which again is a good indicator for kind of where things are going in terms of the Northeast and the U.S. in general. So then when you look at retail sales to inventories, climb in March retail inventories help bring down the ratio of sales to inventories, but still historically high. So still going to have that pressure in terms of moving some things through the system. While the return to office has been long and slow, you can see that the median change from baseline workplace mobility is negative 19%. And that's where we expect that to remain in terms of that negative contribution and being something anywhere between 18% to 25% below normal, which will get worse again as we go through the summer. And then looking at the Kansas City, again, in just a different light in terms of the pressure, in terms of the new orders. And if you think about new orders coming down, you need less people. So that's going to put more pressure on employment, especially as prices go up. And if you can't hire those individuals, or if those people are too expensive, you'll have those layoffs and try to cover that cost on your logistics and supply chain. And this is just showing how prices paid, prices received have continued to push back up and will remain elevated. All the while, home buyer demand dipped 4% year over year, but still strong. Pending home sales index is now well off of pace, and we don't see that catching up, as we've been talking about, with the cost of mortgages continuing to accelerate, which is why the consumers' expectations for an increase in stock prices have dropped considerably. Because when you look at all these pressures, people are going to start to panic. They're going to start to pull money out, and that will again create some of these underlying problems. And then total home equity in owner-occupied housing by generation, you can see that the baby boomers have benefited the most, with the millennials benefiting the least, obviously because home prices have gone up exponentially, which again has capped where people can actually spend money on homes. And then the national payment to income ratio continues to surge higher, which just means people cannot afford it. And which is why throughout all of this, we kind of negate some of the problems that we've seen on the change in real disposable income. We think that there are a lot of, when you look at those shifts, you're seeing, this is from Goldman, you're not seeing the same benefits that I think people were hoping for. And that's why you're seeing this bigger drag that we think gets more prolific as we progress, not only just Q2, but really into Q3 in general. So that's what we have for you on the US. In the next segment, we're going to go deeper into Europe and some of the things that they're facing in that region.